Welcome! Today we're going to dive into one of the most persistent puzzles in finance. It's a relationship that seems like it should be simple, but as we'll see, it's anything but. We'll be looking at some new research that offers a really fresh perspective on this. So, the big question is this: how does inflation really affect the stock market? Now, at first glance, that sounds like a straightforward question. But the link between the two is actually filled with contradictions, and it's much, much more complex than it first appears. All right, so to really get to the bottom of this, we first need to understand this central puzzle. We have to appreciate the core conflict that's right at the heart of this whole debate. You see, you've got two camps, really. On one hand, you have the textbook economic theory. It says stocks should be a fantastic hedge against inflation. After all, they represent ownership in real businesses with real assets. So as prices go up, company revenues and profits should go up too, and stock values should follow right along, at least over the long term. But then you look at the actual data. And historically, especially over shorter time frames, you often see the exact opposite. High inflation has frequently coincided with poor stock market performance. And that right there, that conflict between the long-term theory and the short-term reality, that's the mystery we're here to solve. It's a disconnect that has puzzled investors for a very long time, and understanding it is really the key to seeing the bigger picture. So, how do we start to unravel this? Well, it turns out researchers have found a surprisingly simple, yet really powerful clue that helps in forecasting long-term market returns. The idea is called the real earnings yield. Now, the easiest way to think about it is as a fundamental measure of value. You start with the market's earnings yield. That's just corporate profits divided by stock prices. Then you adjust for inflation by subtracting the return you could get from a totally risk-free, inflation-protected government bond. It's basically asking the question, what are stocks really earning for you above and beyond inflation? And the reason this is so important is that it's not just some abstract academic number. The research we're looking at shows this metric actually works. It serves as a powerful baseline forecast for where the stock market is headed in the future, and it does so with a pretty significant degree of accuracy. In fact, the predictive power here is quite impressive. Over a 10-year investment horizon, this one single metric can account for almost half of all the variation we see in the stock market's excess returns. And what's really fascinating here is how this model's accuracy gets better and better at the further out you look. It has some predictive power even over just 1 year, but that power grows quite a bit over 5 years, and it becomes even stronger over a decade. This tells us it's a very reliable guide for the market's long-term direction. But that begs a pretty important question, right? If this baseline forecast is so effective over the long run, why doesn't it perfectly predict returns all the time, especially in the short term? So now let's explore what causes the market to stray from this path. So we have this great long-term average, this baseline to expect. But in the real world, the market zigs and zags. It swings above and below that predicted line all the time. As it turns out, those movements are not random at all. The research calls these differences deviations, and it has isolated two main factors that explain why they happen. The first one has to do with the overall health and the capacity of the economy itself. And this brings us to the concept of economic slack. You can think of it as the gap between what an economy could be producing if everything was running at 100% and what it's actually producing. A bigger gap means there are more unused resources and more room for growth. So when there's a lot of economic slack, a big gap, it means the economy is underperforming. But it also means that companies can expand and grow their profits more easily without putting a lot of pressure on prices. In that kind of environment, stock returns can often do even better than the baseline forecast. But on the flip side, when there's very little slack and the economy is running hot at full capacity, there's a much greater risk of overheating. That can act as a headwind and cause returns to underperform the forecast. And that brings us to the second and maybe the most critical factor that explains these short-term deviations. And this takes us right back to our original question about inflation. Because what this research reveals is something crucial, that historically negative relationship between inflation and short-term stock returns. Well, it's not a direct cause and effect. It turns out there's a middleman, and that middleman is the policy response to rising prices. You can see the whole chain of events right here. It starts when inflation rises significantly. That gets the attention of central banks, who then step in and tighten policy. Usually, that means raising interest rates to cool things down. This policy tightening then restricts economic growth. And as growth slows, the outlook for future corporate profits gets weaker.
And it's this lower expectation for profits that ultimately weighs on stock prices and causes them to underperform. It's a very clear sequence of events. So the key takeaway here is that investors in the short term aren't really reacting directly to the inflation numbers themselves. What they're reacting to is the anticipated economic slowdown that they know is coming as a result of the policies designed to fight that inflation.
Okay, so now that we have all of the components, let's put the pieces of this puzzle together. Let's form a more complete and nuanced picture of what is really driving market returns. What this research really gives us is a clear three-part framework. We start with our baseline, the real earnings yield, which gives us that long-term forecast. Then we add the context. That's the economic slack telling us about the potential for growth. And finally, we account for the reaction, recognizing that it's monetary policy that's the primary driver of those short-term swings we see around the baseline. So if you take one thing away from all of this, it should be this. When we're thinking about the market's immediate reaction to inflation, our focus shouldn't just be on the price increases alone. It should be on the anticipated policy response and all of its downstream effects on economic growth and corporate earnings. You see, this framework doesn't just solve an old economic puzzle. It gives us a much more sophisticated lens for interpreting the financial news. And it leaves us with a key question. The next time inflation is in the headlines, what should you watch more closely? The price hikes themselves or the policy response that is sure to follow?